Good morning. Happy Friday and welcome back to Real Estate Mindset. You guys know that this live is going to be absolutely bonkers. It will be chaptered. We have a really good lineup for you guys. We're going to end today's segment and video on talking about the derivatives market. So we're going to go back into that, tell you guys how massive that is. Mitch already did a thesis on that, but we really want to hit the points home. And then we're going to talk about 401ks. Mitch has been looking at some of the comments we've been getting from the 401k stuff that we've been saying. So we're going to go over all of that, you guys. This is our fourth live this week. Normally, you guys know I don't do so many lives, but because of the volatility in the in the market, I think it's really important to come live. Let me know that you guys want me to continue to do live videos. But normally I try to keep it a little bit light. We try to split housing market and an economy. But again, you guys, this has just been massive undertakings going on right now. So we apologize for injecting, value into your brains. You guys are probably overwhelmed if you've been following along. And Mitch has been calling it. So I'm really excited to start this show. We're going to do our usual thing: mortgage update, housing market update, and again, derivatives, 401k. Everything's going to be chapter. Before I really dig in, let me say good morning to everyone, and I'm going to say good morning to you real quick. Good morning, Chris. How you guys doing? It's always nice to see you. I can't believe I started the same time as Jack. I feel so bad. Someone tell Jack my bad on that. Dean, good morning. Sean and Wendy, love you guys so much. Chris, what's going on? I hope you guys have a great weekend. So let's get started. Mitch Vexer, good morning, man. It's early. How are you, sir?
Oh, it's not that early. Come on. I've already been here for about 5 hours, so it's not that bad.
You guys, if Mitch could text me at 3 a.m., he probably would, to tell me that gold is at a new record high right now. Am I right?
It is, yeah.
There's my buddy P. Nice.
32.32 is where it was like about an hour ago last time I looked.
Yeah, I mean, things are absolutely crazy right now. Good. There's Monica. Monica, good morning. Nice to see you. Yes, do lives. Love from Magnolia, Texas. It's nice to see you, Monica. All right, you guys, let's get started right now. Let me do my first timestamp. And what we're going to do, and that was a little bit long, sorry. We're going to start with the mortgage update. I'm going to get through the mortgage update quick. In fact, I'm going to get through everything quick so that we can get right into the derivatives and the 401k. So here's our mortgage update right now, you guys. Let's start with the 10-year, which has been basically sideways right now, but it's kind of been all over the place a little bit, and I'll show you guys PPI when we get to that segment. PPI did come out a bit soft, which is good for you and I, right? But right now the 10-year treasury has ballooned up to 4.44%. Now last Friday, so 1 week ago from today, remember this was under 4%. So this is a huge movement in just 1 week. Absolutely astonishing with the 10-year right now. Ballooned up. That's obviously impacted mortgage rates. I'll show you guys that right here. So here's residential mortgage rates. This has not updated today. This is from yesterday's pricing. Now, a few things I want to remind you guys when it comes to residential mortgages, whether you want to buy a house right now or not. Now, really important you guys understand that not all lenders and brokers are the same. They're supposed to be an even service, but that's not the case. They have built-in SRPs, built-in closing costs, built-in fees. So you've got to shop your mortgage. Once you have the first inquiry, remember there's a grace period on your credit report to allow you to continue to shop around without inquiries hurting you. So take advantage of that safeguard. Now, another thing as far as your credit score, remember generally the maximum credit score you need, and then you don't get any special breaks after that, is 760, sometimes 740, but usually 760. Generally, a broker is cheaper than a direct lender. And when I say cheaper, remember what I've been telling you guys. We got to stop saying that interest rates are going up and down every day, even though they are, because what changes every single day more than interest rates? The price it costs to get the rate. All right. So as a loan officer, we call that pricing. So the pricing is what is changing. For example, I can get people a 5%. Even though rates are 6.97, I could still get someone a 5% hypothetically, but that will cost them maybe $25,000. That's referred to as your pricing or a discount, right? Usually it's a discount, meaning that it costs money to get that interest rate. But right now, conventional is sitting at 6.97. 15-year is 6.4. That's the lowest interest rate right there. FHA is at 6.44, VA at 6.45. So FHA and VA about the same. Remember, FHA is going to be a lower interest rate, lower down payment, a little bit easier to qualify for. Your mortgage insurance is generally lower with FHA depending on your credit score and down payment with conventional. So you're going to want to just weigh your options out. But again, FHA comes with mortgage insurance that essentially lasts forever unless you have a 10% down payment, and then it lasts for 11 years. So let's keep going, you guys. Now, I want to show you guys applications for mortgages, and I want to show you guys demand because there's a lot of misconceptions about demand right now. Now, the first thing is, let's go to the refinance demand. You guys are looking at a chart for refinance demand. Now, refinance demand has been shooting up. You can kind of see that, you guys. You see how that blue line is, how well can you guys see that? You see how that blue line is kind of skyrocketing up right here? You see that? Okay, that's the demand. The demand is not for purchasing houses, at least not closed transactions. The demand has been for refinancing. And I'm going to tell you guys, these people that are refinancing, at best, they're saving a half a point, maybe 75 basis point. If you guys refinance generally, this is a general thing. Every situation is different. But if you guys refinance from a half a point lower, or even 75 basis points lower, you've been paying for 2 years. Remember, you start your amortization schedule again, and then you've just put yourself in a situation to where it would have been way, way better for you to rent. Because remember, you start the fees all over again when you refinance. Okay, do not forget that. And I'll show you an amortization schedule. But here's the purchase. Okay, this is what really matters to transactions, the housing market, prices, demand, all of that stuff. Purchases is flat. So interest rates have been going down. So you see the interest rates going down right here, October 23rd, and demand has pretty much stayed the same. And the reason that is, Mitch and I have been talking about this, is because it's still so unaffordable to buy a house because of the price. But again, I want you guys to take away, if you refinance, like a lot of people are, you see that right here. This is so sad for me to see this. If you refinance, you start this over again. This is your amortization schedule. So what I want to do is we're going to go into the amortization schedule briefly. I'm going to put the loan amount of $324,000. I'll put a 30-year right here. Let's calculate this. So you guys just got to be aware of how this works and decide on your own what you'd like to do. But if you get a house for a loan for $340,000 at a 6.97% interest rate, the total amount of payments you pay back is $811,000. So we got to pay this out. We've got to pay this down. That's why Mitch has often said one of the best things we could do for ourselves is get out from underneath our mortgage. The interest alone on $340,000, the interest on $340,000 alone is $470. I appreciate that super chat. I will get there in a minute. I really appreciate that support. But interest alone, $471,000. So your interest is over 100% if you really look at it. And another thing, the best way to pay your loan off early is extra payments towards principal. Okay. And I'm going to just real quick, guys, I'm going to show you how this is front loaded. Okay. So it's amortization schedules. Mortgages are front loaded with interest, meaning you pay your interest first. For example, the first year of your mortgage, you pay back $23,500 in interest, and you only pay off $3,400 of principal or your original loan. But when we go to the last year, okay, it goes from, we'll go to the 29th year. It goes from the last year here. It goes from $23,000 in interest to $994. Okay, so in other words, the banks continue to get filthy rich off of your refinancing because these mortgages are not made for you to pay off. Think about what I'm saying. And remember, always remember it's front loaded with interest. Okay, so let me show you now how to get this thing paid off early. Say you could do an extra, just a little bit. Let's just say $150, okay? Most people should be able to cut $150 out of their budget and put it into your mortgage. So maybe it's a lot, maybe it's not, but it's kind of doable. So let's see what $150 does extra per month. Let's see how much we save. Calculate this right now. All right, so just for paying $150 a month, you turn this into a 25-year loan, guys. So instead of a 30-year loan, it turns into a 24-year, 10-month. That's absolutely incredible. And you save in interest right here. Look at this, $97,235. So you save 5 years and almost $100,000 if all you do is put $150 towards your principal each month. And here's the greatest thing of all. That's your money anyways, because you're just paying the loan down, meaning you're building equity. So in other words, there's every reason to pay your loan off early because you should, if you sold, right? If you sold the house, you get the money back. It's the most amazing thing, but no one talks about that because these lenders definitely want you to stay indebted to them, and they do not want to teach you how to do this. So we're going to go on. Mitch, did you want to add anything to that section? We're going to go on to a video.
Yes. If somebody refinances their house, the clock starts over, and you just created what I've been pounding the table on, which is compound cumulative. You just did it to yourself. And there's no way out, because now you're adding more interest and you're adding more principal. You're doing the exact opposite of what you think you're doing. People say, well, I'll be able to get a little bit of cash in my pocket. Yeah, but that's got a serious cost. And then over and above that, if you go to what's called DXY, that's the US dollar, and you can watch that on a daily basis. So not only do you have the interest clock ticking on that mortgage, but your dollar, if your dollar goes down, which it is this morning, like last time I saw it was about 1.40% down today, as compared to the euro, which is up 1.5%. So the point being that if you're buying goods and services that come in from other countries, your cost of buying those goods and services effective this morning is up. So you have to kind of understand where you are on the playing field. Yeah, you have a mortgage, but your cost to live, depending where you're buying your goods and services from, is up considerably. So you have to understand where that is.
Yeah, I mean, I think it's absolutely fantastic as far as paying your mortgage down soon, because we just showed you guys. I mean, if you don't, they're gonna set the hooks in, and that's not good. Couple things I want to say. Good morning, H-Town girl. What's up? It's gonna get humid out here, and what's up with the allergies in H-Town? My God, my allergies are killing me right now. Marcella Martin, it's always nice to see you. And then Monica, I forgot where you're. Darn it, your comment. But Monica made a comment about biweekly, and I want to tell you, biweekly also helps as far as paying down your mortgage. But as far as biweekly, it's basically just one extra payment a year. So if you guys just put one extra payment a year, it's almost the same, pretty much the same as biweekly. We have a super chat here from Albino. That's funny. So, and thank you again, Albino. I appreciate you. So Trump paused most tariffs, markets still correcting. My boomer father owns his house, and I'm driving truck for Goodwill. In today's market, man, you shouldn't have donated $50, brother. I really appreciate that. In today's market, not a bad place to be. With a correction, it may be my father who owns his house will need my help. What do you think about that, Mitch?
The markets are gyrating, and it's heavy depending on where you are. So even, as I said the other day, people who have what they perceive to be a decent salary, even at $250,000 a year, they also have the corresponding, on a percentage basis, the exact same expenses as a family with a $70,000 income, right? Just because you have a $250,000 income versus a $70,000, the percentage of expenses go up almost parallel, because they have a little bit bigger house, they have a little bit more expensive car, fuel's fuel, groceries are groceries. So on a percentage basis, and then it gets even worse in that who's really at risk? Well, a person earning $250,000 a year who's spending all of it is at much greater risk than a family at 70,000 who's not spending it. So the point being, it affects everybody. You just don't see it in the press because they're too damn stupid to talk about it.
You know, and I read this a couple times. So it sounds like he's worried about it. So his father owns his house. That's good. But I'm trying to read between the lines here that his father probably has a 401k, IRA, some type of retirement account. And so if the market continues to correct, he's worried, I believe, that his father will lose some of that retirement, which makes sense because of its ill-gotten gains. But also, he's also saying in today's market, it's not a bad place to be.
Well, he's got a secure job, right? So he's okay. But we've had all sorts of people come at us from across the United States. We had a vet in Ohio, guy's 84 years old, and due to the real estate taxes, he can't pay the taxes on the house. So what are you going to do with him, right? In other words, he doesn't need care, but the system through their central appraisal district are saying, well, sell your house and then go and drop $80,000 a year in care somewhere else. I mean, there's problems everywhere. So even a person who you think owns their house But if they don't have the cash flow because they're on a fixed income, such as this vet, they got a problem. And the Central Appraisal District, in particular, the chief appraiser there, I suggested it. I suggested that they reach out to the DA, and I suggested that they press criminal charges. They've got him. I mean, this vet is a clear case. He will win.
Yeah. That's a good point. And that may be exactly what he's talking about. You know, even though you own your house, if the property taxes are skyrocketing and you can't pay your property taxes because you're on a fixed income, I mean, that's going to hurt you. I mean, yeah, we've been getting emails from people. I got an email from someone that says, Travis, I'm not willing to fight anymore. He said, I give up. And I was like, dang, man, like that it hurts. It hurts to hear people say that. All right, let's keep going real quick. This is from Les. Now, I don't agree with what he's saying, but I'm proud of him for getting out of that box where it's only the payment that matters. So at least he's saying, Les, he supports us all the time. I mean, he's always on here. I love you, Les. I don't agree with what you say to some people. I don't agree with what you say, but I appreciate you learning. So he's saying total monthly payment amount is all that matters. And then he added for most. So he's listening. Thank you, Les. Thank you. And you know what, to his credit, that's all that matters to most people. He's not wrong about that. That's why most people have buyer's remorse right now. All right, let's keep going here. Lisa, I really appreciate the support, Lisa, a $5 super chat. She's saying, you're the only two that explain everything so clearly. And when I'm tired of talking until I'm blue in the face, I refer them to you. Lisa, we appreciate that. Mitch, do you want to say anything to Lisa?
Yes, we have comments coming like that all the time. It is difficult. These things are very deep. These conversations are deep. Problems with the banks, problems with all the cross-collateralized loans that are going on. And this is unfortunately going to ramp up. I mean, it's just the way that it is when you look at the amount of derivatives. And it's hard. There's no doubt it's hard for people to follow what's happening around them because they weren't educated as to what that is. Well, that's by intent, right? These banks have set out, like, if I told you that you don't own your money in the bank, you would probably freak out, but that's the truth. You don't own the money that you put in the bank. The bank does. So they give you back an IOU, but you hand them $5,000, put it in an account, that money's gone. You've got an IOU. They're under no obligation to give it back to you. So when you understand how that money really works, it makes it difficult for people to swallow. It's hard to understand. Then they take that money and they bet. They make unilateral bets on credit default swaps and all sorts of crap under the hood that is highly levered. And that's why the banks get into trouble, such as Silvergate Bank, right? So these are difficult conversations, but everybody has to hang in there because, like Einstein said, those who have the privilege to know have a duty to help. And everybody that's watching this video, you have the knowledge. It may not be perfect, but you've got the knowledge and you've got the duty to help.
Yeah. And we're going to get to the derivative market. I was like, Mitch, make sure not to talk about the derivative market and so forth. But I mean, it all connects. It's hard, right? I mean, it's hard to keep things segmented when they all run together. Let's keep going. We have another comment from Albino. Oh, okay. Because I was like, please don't donate $50. But he said, and I really appreciate you, brother. You don't have to do that anymore. Go buy someone. If you probably don't go to Starbucks, but you know how people I won't even go there. Never mind. All right. So I also get a military retirement, so I'm okay. So he's a truck driver, hopefully self-employed, and he's also getting military retirement. So his father, so they're both retired. He and his father are retired. So I'm sure they're both watching that. But I really appreciate you. And Albino, don't forget, in all of our videos, we have multiple links, whether you're a homeowner or not a homeowner. We literally have one of the most unique, special home buying and owning programs in the world that's absolutely free. So take advantage of that, guys. And a lot of that has to do with fighting property taxes. Very, very important that whether you own a house right now or not, that you will understand the crisis that's going on right now with property taxes, guys. We need your help for that. And the only way we can do something about it is to be unified. But I really appreciate that support. We're going to go into our first video. Sorry that this is taking so long, you guys. Really good stuff here. I'm going to put our second timestamp for 1930. And our first video is going to be an update on the tariffs and how we are at 145%. China just raised it, I think, to 125%. But let's listen to some of this. It is a little bit nonsense, but if you guys can, let me know that the audio is good. And we're going to get started on the first video.
Around China, Megan.
Hey, David, absolutely. I just got off the phone with a White House official, and I need to clarify, they need to clarify that the new effective tariff rate against China, effective today, is actually 145%, not 125% as they told us yesterday. This is not a new shift. This is based, I want to make clear, on a close reading of the executive order. I have it here. When they amended their executive order yesterday, they changed the rate, the reciprocal rate, so-called, from 84% to 125%. But that comes on top of the fentanyl rate that was already in place this term of 20% against China. So a White House official confirmed to me it is correct to add those numbers together, making the new rate that President Trump has added in tariffs against China so far this term to 145%. A big jump there from where we thought we were even yesterday and the start of the week as well. These numbers just keep increasing. And as you guys know, you do have to add that 145% to any tariffs that were already in place before President Trump took office this term. That's the Section 301 tariffs from his first term, as well as anything else that was already in place at baseline. But now the new rate, when you add all these figures together for this term that they've added against China, is 145% on Chinese imports. Guys.
Megan, a very important clarification. Thank you for that. It does make you wonder, yeah, because I think the broad assumption was 125% included, perhaps the 20% already from fentanyl. I asked this question earlier of Eamon, but I'd love to ask it of you as well. In terms of exemptions, we were talking to an analyst earlier, of course, about Apple, where it may really be so important for a company like that to get an exemption, given how many iPhones are made in China. Do we have any expectations and/or do you have any reporting around what may or may not happen when it comes to that?
The best that we know is that the president said yesterday he was willing to consider some exemptions for some companies, but he didn't want to give any specifics on what it would require. So we don't know anything further than that. We know that Tim Cook has been in touch with this White House, in touch with this president. He's been down to Mar-a-Lago, been trying to win some of those exemptions here, as have other companies. But we just don't know yet. What I will say, despite just how high this China tariff is, now even higher than we initially thought, there is some more optimism now because companies like Apple that have production in other countries as well, they can at least move around. But I will say that, there was softer language from the president yesterday that at least he's considering exemptions. We didn't get that before. And if past his prologue in the first term, we did get some. So I would expect a lot more to come on that front.
I mean, a few things. The rate is so gargantuan compared to, first of all, the other tariff rates that we have and everything else. It makes me think that they're bringing them to the table to a deal, because at some point it's just unsustainable to have trade this way. And then their tariff rates now on our exports into China are what? Above 80%?
84, right?
They're at 84%. Yep. And they're doing all these other things. The TikTok deal, for example, is on ice. The president acknowledged that yesterday. The companies that have all been added to the blacklist, the entities list. I saw a headline this morning that China's buying some soybeans from Brazil. That's a hit to U.S. farmers. So China can do a lot more. I agree with you that I think with rates this high, you would think there have to be negotiations, and potentially we'll see those in the coming days. But I've been kind of amazed over the past few days just how little conversation has been going on between the U.S. and China. It doesn't seem like there's any sort of dialogue at this point. We've seen the tit for tat escalating without the leaders, at least, getting on a phone call.
Okay.
Fast and reliable.
Got some good questions as that video was playing. We're going to go into our, hopefully I didn't just delete that. Oh my God. All right. We're going to go into our market update, and we'll get back to some of these questions, you guys. And the reason I'm doing that is I want to go through this quickly. Mitch, did you want to comment on that video?
No, it's not really relevant, because the truth of the matter is 145%, in my humble opinion, isn't enough. And I don't want to state what's necessary because I don't want to give anybody ideas, but not relevant to anything. It's just, it's a negotiation. It should go down to zero straight across the board from all countries, right? We sell you our goods, you sell us your goods, free, fair border trade, period. Anything else isn't acceptable. And whatever the outcome is what the outcome will be.
You know, a lot of people don't like them. A lot of people do, but everyone is confused about the tariffs right now, and whether or not they're real. Is it is it just a negotiation? All I'm saying is I don't care. Let them crash. More pressure on the banks, the better, in my opinion, and the derivative market. And we're going to get into the derivative market. But let me show you guys what's going on with PPI. We're going to start our market report real quick, and we're going to cover that quickly. We'll get into the housing market, then we'll get into derivatives. Here we are, guys, with PPI that came out. Let me switch my camera view to my other computer here. So PPI came out this morning, and take a look at this. I'm going to go to the bottom here and show you guys just straight to the bottom. Came out big load, negative 0.09%. That's good. That's good because as consumers, we want things to cost less, right? We need things to cost less. We want prices to go down. But anyways, guys, very interesting. Now, I did want to tell you guys in 2024, there was some reports as well of negative reads. You see that right here, March of 2024, June, May of 2024, September as well. But this is a big one. This is 0.9, and it looks like it's led by energy. Probably gas prices. You guys see that right there. So energy went down 4% in this is just 1 month. That's pretty impressive. So that's what PPI is. Let's see what the market is doing real quick. Market's not open yet. So futures look to open positive on the stock market. Let's see if we got any recent updates on the market. So the 30-year treasury bond heads for worst week. Dang, that's crazy. Since 1987 as yields surge. So obviously, oh my God, look at that. So the yields, let me see. That's crazy. Oh, look at that. Damn. Look at that right there, Mitch. You see that? That's crazy. That just happened. I mean, this wasn't like that when we covered this. The yields are also at 4.5. The 10 years almost at 4.5 right now. That's crazy. That just happened right now, literally as we've been live. That's insane. Look at that trajectory.
Yeah, except for one thing. We said this 3 days ago.
I mean, this is crazy. It's the amount of money. It always blows my mind, though. So treasury yields rise after wholesale inflation reading. Interesting. Okay, let's keep going real quick. Dow Jones higher after latest inflation report. Fed's Kashkari sees stresses, but not big dislocations in financial markets. Probably the derivative markets and the arbitrage that's going on there. Wholesale inflation in the U.S. drops for the first time in 17 months thanks to cheaper oil. It won't last. So that oil is it's making an impact. Wells Fargo sees equity total market revenues dip slightly. Gold hits fresh record high north of $3,200 as investors run for cover. And Warren Buffett has already, remember you guys, Warren Buffett moved to cash, a lot of cash. Don't ever forget that. If you're, what do I do? What do I do? Who do I listen to? Remember, cash talks. He went to cash. His actions speak louder than anyone's words. Wells Fargo CEO supports Trump trade policy, but hopes for a timely resolution. So some people, they want this to happen. JP Morgan Chase sets equity trading record as market revenue jumps. Interesting. All right, guys, let's keep going here. Let's look at the VIX. So the VIX is shooting. Look at this. Also, so something happened. So the VIX is shooting up. I really appreciate you guys' super chat. I'm going to get right to that. So the VIX shot up. I'm not sure why, but that's a healthy increase. So, so that's interesting. That's very interesting. So the VIX is up almost 10% right now. So things are changing right now. Look at this too. Dang, Mitch. Look at gold. Gold's at 32.48. That's a new record. I think we just hit another new record right now. 32.48 for gold. Absolutely phenomenal. That's up another 2%. My God, gold has been just absolutely soaring. Now, you guys know I invested in silver, so thank good. I mean, I already got my premium back on my silver. This is absolutely incredible. You guys know I bought 100 ounces. I'm not telling you to. I bought 100 ounces of silver because I want to be a mature adult. So silver's at 31.54, up 2.5% right now. Holy smokes! Let's keep going. Oil. So look at this, man. This is also plummeting. So at that news, that's really interesting movement here. So oil's going down again under $60 a barrel. That got to, I think, Mitch, 55, around almost $54 a barrel this week. So it's all over the place. Let's keep going. Here's Bitcoin. Let's see if there's any movement in Bitcoin. So Bitcoin's at about 154 right now. Interesting. Let's keep going. Reverse repo market. So this is a form of bank bailout or quantitative easing, a form of quantitative easing. There's 129 billion still in there. It's not going down. It's just staying stuck. I mean, It is what it is, you guys. It's absolutely depressing. And I wanted to remind you guys once again that the Federal Reserve has at least $6.7 trillion in assets. And I wonder if they're leveraging that up in the derivative market as well, that $6.7 trillion in assets right there. But don't ever forget what the Federal Reserve does to us. They could literally take those assets and help us unwind some of this debt. Here's the 5-year break-even inflation rate. Look at the movement here. Look at the movement with the 5-year. I mean, this is crazy over the last week. So, and this is good. So it went from 2.61 and it's dropped down to about 2.31 and it's sitting at 2.32 right now. So people are starting to expect inflation to lower, although it's still extremely elevated. But this takes us back to around the end of last year. Now, this is interesting. Let's see if this has changed this morning. This is GDP now. So GDP now for Q1 of 2025 is now suggesting that we're going to be down 2.4%. So for those people that don't think that we're facing a recession, a lot of data is now specifically saying otherwise. And I understand why people would say we're not going into recession. The Federal Reserve has been bailing us out of recession for decades. So I understand. So they have a point. But I also want them to understand that if it was not for that bailing out, we would already be in a depression right now. That's not what's been happening. So this also updated. I think this updated yesterday, Mitch. This is the deficit spending. And right now it is, I mean, it is so bad that even the cuts that Doge is making, it doesn't even matter. I mean, because the deficit is 1.3 trillion. 1.3 trillion. You just make sure. 1,000 million.
Yeah.
1.3 trillion. I know, I'm just joking. It's like I always second guess myself. But we're in, and this is not even over yet. We're still have more. Obviously, the fiscal year goes to October, but it's absolutely out of control. And just to show you guys, so we're at 1.3 trillion already in 2009 for the entire year, and that was the global financial crisis. That was a great recession. We were at 1.4 trillion. So you can't say that they're not keeping us out of recession. They're keeping us out of recession and making the debt and fraud bubble even bigger because all they want to do is keep the fraud system going. But you can't dispute whether or not we're headed to recession because we can see that with the deficit spending. They're keeping us out of that, guys. Now here's M2 money supply. And I just wanted to show you, this is the 5-year outlook. Let me go to the 1 year. They've been pumping money in the system. You see that right there? So I wonder if that's inflation. I wonder if that's inflationary right there. Probably inflationary, yeah. So there's the inflation right there. You guys can see that going up right there, and that does suck for us. But that's your market update right there. We're going to get into a video, but Mitch Bexler, did you want to comment on anything I just went over? Oh, you're on mute. I apologize. You're off of mute now. That was my fault.
Okay. So if you stand back and look at all the PPI, the CPI, the market sentiment, the GDP, if you look at all these things, they're basically levers. They're levers that are being pulled. And then you get into the derivative side of it. Well, the derivatives are bets on the levers. So then if you go to your bank and you say, well, okay, I've got my cash, the bank took my cash, they invested it, maybe they got US treasuries, and then they took other assets that the banks may have in exchange for those treasuries to balance off their books. These are all levers that are happening at the same time. The problem is that many of those levers in terms of percentages are somewhere between 600 trillion and 800 trillion worth of paper chasing paper. That's what is being allowed to happen at the banks that is off balance sheet. You can't see it. It's there, but you can't see it. They purposely put it off balance sheet. So that is where the problem is. And we'll get into it a little bit further as we go through this. But the dollar, so what you're saying is, okay, great. Things are getting a little bit better on the producer side of things, except no, they're not, because the US dollar is getting weaker. So it's a lever with the idea of trying to balance out the system. The problem is there is no way to balance out the system given the derivatives. That's the point.
Market opens down 300 points. That's crazy, man. So let me show you guys real quick.
I
since
rest
we're
my
still,
case, Your Honor.
this is crazy. I mean, you guys are literally experiencing this live right now. I mean, the whole market just shifted. It was going to open. It was going to open positive. The Dow, S&P, and NASDAQ, and it's now down. And I'll show you guys here in a minute. I want to get to this question real quick. This is from the Italian Stallion, aka the Gangsta Bankster. Sir, thank you for the support. We appreciate that. Another president question. Man, I hope you're absorbing this flattery. And so you got another president question, Mitch. What government officials? Okay, so if Mitch were president, what government officials would he send to ECOT prison in El Salvador? I think you're saying who are the most corrupt. You got to be careful here. He's setting you up to irritate a lot of people, Mitch. But since he gave us a super chat, who would you send? What government official would you send to prison right now?
In the criminal complaint that I filed and the First Amendment to the criminal complaint that went to the DOJ, it names names, and everybody should go read that. And I've even said, does it do good for society to put all those people in jail? Maybe yes, maybe no, so it doesn't happen again. Here's the underlying point. Their actions are proven criminal. So I can't prosecute those people, but their actions are clearly criminal. When you understand what's happening at the Federal Reserve and how many trillions of dollars that have been pumped into the system by virtue of fraud for the sole purpose of maintaining the balance sheet at the banks, that is criminal. There's no other way to look at it. If you walked into a jewelry store and said, okay, I want to buy 5 pieces of jewelry, and the jeweler turns around to you and says, okay, but I don't have it in inventory, but I'm going to sell you a derivative of the fact that I may get it in inventory. Would you pay for it? Well, that is exactly what the Federal Reserve has done through the reverse repo and the repo. By any definition, it's fraud on a mass scale. Over and above that, your central appraisal districts have created $21.25 trillion in the last 5 years worth of overvaluation, with the resulting overtaxation in 2024 alone at $450 billion. In 1 year, they stole $450 billion from mom and pop. The central appraisal districts and the Federal Reserve are the largest purveyors of fraud on the planet, bar none. So the answer to the question is, where would I start? Yeah, absolutely, the central appraisal districts and the Federal Reserve. I've said publicly, the Federal Reserve, the doors should be chained.
Well said. I did an interview yesterday, and it was supposed to be a housing market interview, but half the interview was about the Federal Reserve. I got to show you this because this is absolutely insane. Look at the 10-year, man. Look at the trajectory on this 10-year. It's over 4.5 right now. This is going to send residential mortgage rates up. They're going to be over 7%, you guys. So if someone asked, could you talk again about the mortgage rate? So when this updates right here, again, this is not pricing in the 10-year yet. When this updates, you're going to see this, as far as the 30-year conventional, it's going to be over 7%. So when that updates, it's going to be over 7%. FHA, no. FHA is probably going to end about 6.5-ish. So FHA will be 6.5, but conventional, you're back over 7%. That is absolutely incredible what's going on. Look at this. Look at the trajectory. Almost, geez, man, almost up 8 basis points. It's going straight up. I mean, someone's ditching these. This is crazy, man. Let me show you guys the market real quick. Look at this, Mitch. Market reversed. Dow's down 303 points. S&P down 34. NASDAQ 49. My God. I mean, it completely shifted. Just that's crazy. VIX is up almost 9%. Okay, let me go into the next video. I'm sorry, you guys. I mean, this is just absolutely incredible. Here's our next video. This is from the Treasury Secretary, and he's going to go into how Wall Street's doing good, and now it's Main Street's turn. And I would say, what do you mean it's Main Street's turn? It should have always been Main Street's turn and then Wall Street. But the market has it the opposite. The market's taking care of Wall Street before Main Street. So don't forget that, you guys.
No. The Federal Reserve is taking care of Wall Street. The Federal Reserve does not exist to help mom and pop. It never did. Its concept since day one was to protect the banks from bank runs. It has morphed into the absolute devil. I mean, there's simply no reason for it to exist. If people knew what was going on under the hood with regard to these derivatives, you'd probably have riots in the streets. I'm
going to show them. But what did I say? I meant the Federal Reserve. What did I say? The markets?
No, I think what you were saying is that the Federal Reserve, because Bessett is talking about, well, it's now Main Street's turn, but you can't sit on both sides of the fence, right?
Yeah, well, that's exactly what the Federal Reserve does. Actually, no, the Federal Reserve only sits on the side of the banks. They lie to the public. They lie to
Yes.
Main Street.
Yeah.
I mean, it's absolutely disgusting. But listen to what he has to say, and let me know if the audio is okay, guys.
And we're putting a process in place, and as you said, you're going to be part of the negotiations too. Because I've had these countries call me up, and Secretary Bessent, we're happy you're going to be negotiating. Well, President Trump's going to be involved too. So, bring your best deal on the budget. It's moving quickly in the House and the Senate, thanks to your leadership. We're also going to have debt ceiling in there, so we're going to get an increase in the debt ceiling. So, and that will be the done and dusted for
part of the bill that we just got to vote on today.
part of the bill. It'll be done and dusted for 2 years. We won't have to worry about that. And then I gave a speech yesterday to 1,400 small and community bankers, and they were so happy to hear from your administration. And I told them Wallstreet's done great for the past 4 years, 10 years, 20 years. It can continue doing great, but it's Main Street's turn now. And it's those small bankers through deregulation, through emphasis on Main Street, your Main Street agenda, bringing back jobs, that is going to power the smaller communities. And then finally, the bond auction went very well yesterday. We had a lot of foreigners show up as the support, showing that the U.S. is still the best place to invest. The inflation report, as you said, was quite good. And energy prices are down more than 20% since January 20th.
Amazing. That's great. Very good. Good numbers.
Great number.
Thank you.
President, we've had some
It was
great
the Treasury
wins in the
Secretary
last
speaking in the
few
cabinet
days.
meeting and talking about how negotiations with the Vietnamese are underway. He said we're putting the process in place for negotiations, and that he and the Vietnamese deputy prime minister have agreed to begin formal discussions on reciprocal trade between the United States and Vietnam. That was actually a Treasury Department statement. But Vietnam has, of course, been one of the flashpoints here as countries that had shifted their supply chains there were surprised to find themselves facing these big tariffs. In fact, Steve, let me just turn back to you to kind of finish the thought on where we were. Should we go to Rick first? All right, let's do that. 1 second.
Okay.
30-year auction, top of the hour. Obviously, all eyes are on bond yields. And Rick, let's bring you in with the results of that. How'd it go?
Yeah, it went very, very well. We just heard the Treasury Secretary bragging about yesterday's 10-year auction. Today's 30-year, well, technically 29-year, 10-month auction went every bit as well. The yield was 4.813. What's notable there, and what gets the biggest grade markup, and this was an A as an apple, is that it was 2.5 basis points below the when issued market. Lower yield equals a higher price. The government was the seller. You heard me say that many times. So back to back, very, very well received auctions. Now, if we pick some of the metrics, one that jumps out at me is that the dealers took a little over 12%. The 10 auction average is 15%. All the metrics were good. And as you see, yields moving lower, led by the long maturities. That's very fascinating today because most of the action I'm buying has been in the short maturities, like 2-year, 3-year, 5-year. The long-dated Treasury yields, for the most part, have been higher all day, but they are now starting to come down a bit. It's going to be very interesting, Kelly and Steve, to see how we relink with what's going on with equities. We went from very direct relationships about a week and a half ago when there was a real flight to quality. And yesterday and many of the days recently, we see that that's going in the opposite direction. Higher yields have been hurting equities. So right now, I want to see if this drop post-auction, and by the way, that's the end of the auctions, 3s, 10s, and 30s. Now that supply is done, see if it has any lasting effect on the relationship with equities.
All righty, so I got you off mute, and we have a comment here. But at first, I want to say this. I don't know if you caught it, Mitch, but when the Treasury Secretary was speaking, he said that he plans to deregulate small banks. And when you said that, I'm thinking, well, what about the 1 quadrillion derivative market? If they were overregulated, we wouldn't have 1 quadrillion in derivatives right now, and the whole freaking market collapsing. And you're going to deregulate them anymore? You didn't even implement Basel III. Basel III is not even implemented.
And that is exactly why I just said a few minutes ago, without even benefit of the video, you cannot sit on both sides of the fence. Somebody has got to wake the hell up and understand what's going on with these derivatives, right? You have two mirrors looking at each other. The Central Appraisal District is a mirror of the Fed. They're creating fraud. It's that simple. If mom and pop knew that there's quadrillion dollars worth of derivatives, of which somewhere between 600 trillion and 800 trillion is pure fraud. This is paper chasing paper. You got to understand, you cannot get to the asset behind the paper. It's so perverse. They're literally saying the paper is the asset. The paper is a bet between different banks that may be cross-collateralizing their own loans via the reverse repo and the repo markets. That document that I put together, called the Thesis and Fact, gets into the details of how that money moves in a giant circle. That's all it is. There's no assets behind it other than the US Treasury themselves. But they shift the US Treasuries from the Fed over to a bank that may be in trouble to cover off their balance sheet. It's an illusion. And that is the problem with all of this. So I have no idea what anybody at the Treasury knows. What I do know is that the derivatives are real, right? It's not backed by an asset, it's paper. So the paper chasing paper is a real problem. And if you associate that with, if it's so good, then why is it off balance sheet? Let's do the reverse of this. So it's off balance sheet because they're hiding the facts from the public. Well, you only hide things from the public when you're not telling the truth. So the fraud exists, the fraud is real, and I don't like this idea where nobody seems to be paying attention to it. And then as far as Doge is concerned, because there is truth in that, like they are making headway. But the problem is that the interest clock at 1.3 trillion in deficit is superseding anything that Doge can do to the good. You want to start making real change here? Start hacking in the trillions, right? So there's give or take, $5 trillion worth of outstanding school district bond fraud in the United States. The stroke of a pen can get rid of it. It's not real to begin with. There's no asset backing it up. The schools aren't worth a damn. Then with regard to the Federal Reserve, you got the exact same thing going on. It's the mirror image of fraud. Where are the assets? Okay, it's okay. You want to say the U.S. Treasuries are an asset? That's great. Now, what are you going to do with the other 600 trillion worth of derivatives under the hood that are pure paper chasing paper? Somebody answer the question. And that's the point of all of this. They're going to blow the system up because either they're not paying attention, or they're stupid, or they're giving up the opportunity to actually start slicing the trillions of dollars to start reversing the debt clock. And that's what's got to happen. This debt clock has got to start going in reverse. And you can't get there by poking at little minuscule items. You got to get there by hacking trillions at a crack. And yes, there will be pain. Whatever bank is involved in these derivatives, see ya, you're gone. And that's going to be about 70% of the banks. When all said and done, they deserve to be put out of business, just like the school districts.
I mean, but he's not saying that. He's saying
No,
the
he's not.
opposite. And that's what concerns me. And Mitch and I off camera, probably the thing we talk about most is the administration going to bail out the banks? Are they going to bail out the financing sector? And it's like, oh gosh, man, it looks like they're going to put another round of QE in there, another round of QE, quantitative easing, another round of printing. And all that the printing does is, again, it says all the time, but when they print money, they switch and transfer wealth from middle class, lower class to the elite. And in the process of printing, not only are they making these elites filthy, disgusting rich, they're putting millions of Americans in the crosshairs of poverty, and not for just a little bit, poverty for a long time. Once you go bankrupt, sometimes it depends on the person, right? But for me, it took 9 years. So I went bankrupt. It took me 9 years to get back to where I was before I went bankrupt. So it's just, I hope you guys vote it down, right? Don't vote for bonds, vote any expense from the government down, because there's too much fraud in the middle, and that money is not getting to where it's supposed to go. And that is really what we're saying. We believe in the schools, all these things we believe in, but what we're saying is the money is not going to where it's supposed to. It's going into the pockets of these rich people, and it needs to stop. And when I hear things like that, it makes me concerned. It makes me concerned. And that's why I always say that everyone in politics is guilty until proven innocent. And I don't see anyone innocent right now. I want to believe in people, but I certainly do not. We got $100 super chat, Mitch. And I know you want to say we're not even to the derivative part yet. I still got to go through the housing market. But we have $100 super chat from Joe. Joe, thank you, brother. I appreciate the support. This is a very important question. So, Mitch, I want you to try to knock this out, but I'm going to read this. I live in Minnesota, and we have known fraud since 2019 in the tune of 611 million. 250 million was associated with an organization called Feeding Our Futures, and that's what I'm saying, right? So that organization, if you donate to that organization, it's from just reading the title, that money's supposed to go towards feeding people that are in need. But more than likely, the money is not going to people in need. It's going into the pockets of a handful of people that are ripping us off. It's pattern and practice. Now, as of yesterday, our state AG has been found connected to it. The attorney general, really, the state's attorney general. Okay, so I mean, that's the ultimate level of corruption and fraud, right? How can I fight this level of corruption? What can you tell this patriot here? What can they do, Mitch?
The answer is get your hands on the sample criminal complaint. It's below one of Travis's videos, and he'll put it below this one just to make it easy for you. But filing a criminal complaint is the net result. So we filed the original criminal complaint with Pam Bondi about a month ago, followed up by the First Amendment to the criminal complaint. And to your point, I pointed out in that criminal complaint that our governor, Governor Abbott, and I wish this wasn't the case, but he's actually the chairman of the BRB, which is the Bond Review Board here in the state of Texas. There was a delta between the BRB's numbers and another government operation called the Texas Education Agency. The delta was 24 billion. So when you understand what's going on, one must ask, well, okay, and what school district put money into the coffers of the politicians? It's the only question that can be asked. So is it true? I don't know. That's not the point. The point is, A, how do you figure out how did you get to a delta of 24 billion? Why did you get to a delta? Governor Abbott, what in the world are you doing on the BRB board to begin with? By the way, Dan Patrick's also on the board. So these are serious questions, and they have to be answered at a minimum, just simply to put the fears in people's mind to rest that these politicians are not getting money from the school districts. And if they are getting money from the school districts, they've got one hell of a problem, because you're making votes that you should have recused yourself on. They didn't do it, right? And this is all tied to the real estate tax. It's your property taxes that are paying for this corruption. So read the criminal complaint. You will be shocked, but it ties to what you've got in Minnesota. By the way, you're not the only person out of Minnesota that's reached out. We got people literally from every state in the union with very similar stories. And then with regard to Glenn Hagar, I've said publicly, I only really want two depositions. I want Glenn Hagar, who is our state comptroller, but I want him because he's in charge of the property valuation study. He'll state in public, well, we don't set property values, yet the property valuation study is used as a cudgel against the chief appraisers. You must go and raise your property values higher because we need to take the additional money and move it from this school district over to this school district. I've got some pretty interesting questions for Mr. Hagar. I want his deposition, and I want Don Spencer. I get those two depositions, this entire house of cards is coming down. We're ready. We're locked, loaded, ready to go. We got to get it through the court, but we're aiming as soon as we get it out of the Fort Worth Court of Appeals. That's exactly where we're headed. If the Fort Worth Court of Appeals punts, then they would literally have proven that the state of Texas has violated its own constitution, and we will be in front of the U.S. Supreme Court. This isn't going away. These problems are real. They deserve to be answered. $450 billion was stolen in 2024 alone via the overtaxation and overvaluation, and that ties right to Joe's comments. This stuff is as corrupt can be. The math is the math. And with well over 5 million views in all these videos, and me constantly asking people if there's anything that we've said, if there's any information we've put out there that's wrong, for crying out loud, let us know. We'll fix it. Not a peep from anybody, including the government themselves. Why? Because it's the government's own documents. It's their video. It's their testimony. It's their sworn testimony in public. It's their sworn testimony in the press. We've just added it all up and said, this is what's happening. These are crimes against society.
Absolutely.
So to Joe's point, yeah, he's 100% right.
Well, and Joe, let me tell you too, once we're done with this live video, because I have to finish the broadcast, I have to let it process, and then I can go back in and I can add things to the video description. So I'm going to add, after this is done recording, I'm going to go back in there and I'm going to add a direct link to the criminal complaint. You can get it in the Empowerment Center on Real Estate Mindset. So it's already there, but just to make it easy for you or anyone else that wants it, I'm going to link the criminal complaint and the thesis in the description of this video. So if you guys want to come back, excuse me, maybe about an hour, you'll be able to easily click the thesis and also the criminal complaint. And remember, this video is under live video. So Joe, we appreciate you. In other words, you may want to file a criminal complaint. And that's honestly, I've been thinking about doing the same thing when it comes to new home builders because of the IPCs and the seller concessions. I'm like, someone's got to do something. So I was like, you know what? Maybe I'm the one that should file a criminal complaint against the builders because they're violating law and they're being warned about the violations and they're still doing it. And they were warned by Fannie Mae and Freddie Mac as well for seller concessions. They're still doing it. So we need to take more actions as citizens for sure. And again, you guys don't forget that criminal complaint is in there. So we're going to move on. And I really, really, really appreciate your support a lot. I've been getting a lot of good comments as well. And I've started a lot of these comments because they're just so good. And we're going to get to that. But I wanted to show you guys what's happening in the market real quick because it is changing. Market's up now, 143. I mean, and this is insane. I mean, the whole zigzag thing is absolutely incredible what's going on. So everything is up now, including the VIX. So at the same time that the market's up, the VIX is up 10%. Talk about volatility. Talk about the lack of fundamentals. So again, there you see right there, the VIX up 9.2 and the market's up. That's crazy. Oh, there's a warning right here. All right, but the market's up. So that's going to be interesting. But I want to show you guys now. Let's go into the housing market. Let me do another timestamp for our housing market report. And we'll just keep moving right along here. Starting with this right here. This just came out. I want to tell you guys real quick. So again, just to put things in perspective, overall, and I'm just going to go ahead and say this, it's generally much smarter to rent right now, not for the rest of your life. Okay, I'm not saying for the rest of your life at all. I didn't say that. I said right now, being that the housing market is so overvalued and toxic, but look at the gap right now. So homeowners need to earn another $50,000 more than renters. And to put it in perspective, in 2020, it was about a difference of about $8,000. So in 5 years, it goes from a difference of $8,000 to $50,000. That's crazy. And also, guys, Redfin came out with a report yesterday. And a couple things here that I want to go over with you guys. Boom, 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 boom. Let's start right. We'll go over some leading indicators right here. So leading indicators, new median sales prices is the 4-week rolling. And this is methodology. This is not raw data. Remember that. This is not raw data. If we had raw data, this would be completely different. But median sales price is up only 2.5%. That's the smallest increase since October 2023. When it should be going up. So that's interesting. And then some other things, pending sales down 1.1%. So it's interesting that people say that mortgage applications have skyrocketed up, but yet pending sales have not. The reason for that is because it's just an application. You can fill out a mortgage application. That doesn't mean you're going to buy a house, especially if rates just went up. So they did a whole bunch of mortgage applications. Rates went up 0.5 point. Those people no longer qualify. I know they no longer qualify. A lot of them no longer qualify because absolutely everyone pushes their qualification to buy a home to the maximum debt to income ratio. So when you have these fluctuations of interest rates, it really impacts those people that have applications out. But this is also good, you guys. Months of supply, 4 months of supply. That's absolutely spectacular. Let me show you the winners and losers real quick. So the winners of the housing market, or the ones that are still going up: Cleveland, Ohio, 12%, Milwaukee, 10%. Dang it, this one always gets me. Newark. I didn't say that right. I know. Newark, New Jersey, up 8.8. Nashua up 8.8, and New Brunswick up 6.9. Now we have 8 metros, and this is a surprise actually when I saw this. So we have 8 metros, and the surprise is the number one declining metro area is actually Indianapolis. That was a huge surprise to me. But that's down 4.4%. And then we have Jacksonville. So that Jacksonville's probably the leading metro in Florida that is having decline right now. So Jacksonville, and then Tampa is number 5. Number 3 is Montgomery County, and number 4 is Dallas. You'll notice that Austin's not in here and San Antonio's not in here. I wonder if it's part of those 8 metros right there. Now let me show you guys new listings, because new listings is the name of the game. It's only declined. This is absolutely beautiful. This is absolutely beautiful. This is a signal that inventory is shooting up and demand is not keeping pace, because only 2 metro areas declined in inventory year over year, and they didn't decline by too much. But look at the increase of inventory in these leading metro areas. Number 1 is Phoenix, 25.9%. Look at Washington D.C., 25.8%. So probably what we're seeing here is finally those layoffs starting to impact the housing market, and it should, because there's 250,000 layoffs in the District of Columbia. So 250,000 layoffs in the District of Columbia. So you're going to see that hit the housing market for sure. Montgomery County is up 25.7, Pittsburgh up 22.2, and surprisingly, Cleveland's on here as well. So on one hand, Cleveland is leading as far as home price appreciation, but it's also number 5 for new listings. Now let me show you guys some important stuff here. Here's housing payments. So home buying housing payments, record high. All right, so this bad boy is record high. So not only do we have a price problem, we also have a payment problem, sitting at $2,816. Back in 2022, this was about $1,700. So we have mortgage payments from 2022 to right now, so about 4 years. Okay, so about 4 years, it goes from $1,700 to $2,800. Are you kidding me? Why did that happen, guys? We could just say the Federal Reserve. Let's just say the Federal Reserve is why that happened. Now, this is a very important data matrix to look at. This is new listings coming to the market. If we see this continue to skyrocket, usually, we could safely presume that it's from distress. Could be foreclosures, could be from the job losses, whatever it is, we need new listings to shoot up. If new listings aren't shooting up, then all that's happening is the existing stuff is just sitting there, and slowly, those, especially if they're in distress and the days on the market increase, we'll have more price cuts. But new listings coming to the market puts even more pressure on the existing inventory, and we need that to go up, not quite where we were pre-pandemic, but very close. That is up 10%. So that's up 10% year over year. That's very good. We need it to be higher, though, to be honest with you. Active listings sitting at 984,000. We are well ahead of schedule from last year. You see that last year at this time we had under 900,000. We have over now, so probably about 100,000 more. Here's the beautiful thing. Here's months of supply, 4 months. So more months of supply than we've had in a very long time for this time of year. You see that right here. So it is elevated. Demand is not keeping up. Let's see here. That's probably going to do it. I wanted to show you guys one more thing to just constantly remind you guys how this works. So I'm going to access MLS. I use the matrix. This is what realtors do, right? So realtor, you get a license, you have access to the multiple listing service where active real estate can be found. So I go into the matrix. Here's my setup. Remember, if you're a realtor, especially, pay attention to what I'm saying. If you're shopping for a house, pay attention to what I'm saying. When I do my searches, I supersede all of this fluff, right? Size of the house, whatever, right? I'm superseding all this because right now what matters is the price, Les. Okay, a little bit the payment. Okay, yeah, the payment does matter, but price is more important. So I just start with price per square foot, $120. So I take 30,000 listings and I turn 30,000 listings into 2,200 listings, okay? Let me do the map real quick. So I'll pull up the map. And now I can see if in the area that I want to purchase, are there any homes that are potentially under market value? The reason why I put price per square foot is so, again, I know that most of these houses are under market value. So let me click this listing here. Let me show you guys what it's looking like. This is active. This is live right now. So this is an active listing. We had a price cut right here going from about $350 to $337. So about $13,000 price cut. That's what, about 2.5%. Been on the market for 51 days. So it's just sitting there. But I want to show you guys the tax problem just to really hit this home. So it cannot be sold for $337. It cannot be sold. We know that because it's been sitting on the market and no one's bought it, right? So $337. But when we go to the taxes, remember $337. Let's see what this is being taxed on, okay? So let me scroll down here. All right, it's not $337. It is being taxed on $383,000. They bring Rob minimum $45,000. So this home is overassessed by a minimum of 45,000. And don't forget, you guys, a lot of people think, wow, homes are so cheap in Texas. You're right. Comparably, they're cheap, but look at the property taxes on that house. The yearly property taxes are $9,000. So it's quite expensive. All of this to say, probably you're going to want to wait to buy a house right now because you see the dynamic shifting depending on your local area. Some local areas are not doing well, like New York is not doing well. San Diego's changing, but you're probably going to want to sit this out. And as you're sitting out the housing market, it's probably a really good idea to invest in yourself by learning how it works. I provided you guys all of the courses. You can literally, when you're done watching this, you can go to the Empowerment Center and take 2 courses. Take the how to do a market analysis and the home buying master course. Those 2 courses alone is going to make you guys better than 100% of the buyers. You're going to be the top 1%. That's how important it is. And it probably takes both courses 2 hours. It's an hour a course. That's it. 2 hours, guys. 2 hours to get 20 years of my experience in 2 hours. 20 years to 2 hours. Get the point? There's a lot of value there. We got another, let's see here. We got another super chat, and we're going to move on to our next video. Let me tee up the next video. Buffalo, I appreciate you. Buffalo Blanco. I came to watch Mitch. See, Mitch, I mean, you get so much flattery. If you're a president, I come to watch. We don't care about Travis anymore, but, I'm just hanging in here, man. I'm happy to be part of this. You know what I mean? I'm just the cameraman, guys. To be honest, I'm just the cameraman and editor. All right, I've been searching for homes in Houston areas with good schools, still have bidding wars. New construction is fair. So what city? What city are you having bidding wars in? And in what context? Because I see a lot of the inventory skyrocketing, days on markets going up, and price cuts surging. And also for new construction, Buffalo, this is what I want you to do for new construction. First of all, your realtor should be helping you. Also, are you using a realtor? New Home Source. So this is where I want you to go. Okay, for new construction, go to New Home Source. This is what it looks like right here. This is New Home Source. Okay, you put in Houston. First of all, I'm not saying to buy a new home. These are crappy houses as far as the building. Look at how many new homes in Houston. Okay, and this is underreported, but this is where you go if you want to kind of see where the clusters are at. Buffalo, 12,591 new homes in Houston right now. That's how many is in Houston. Again, this is New Home Source. This will help you kind of get a general idea. And there's price cuts surging everywhere. I mean, there's literally price cuts everywhere. So I'm not sure. Let me exit that real quick. I'm not sure where there's bidding wars or if it was just one house, but there are still some neighborhoods, especially like in Katy. But Buffalo, tell me what area you're looking in if you can. Let me try to find Buffalo's comment real quick. Did you want to say anything, Mitch?
Yes. So yesterday, I received a phone call and a text from a friend who's looking at a house in Taos, Michigan. It's a 1,509 square foot house that's on the market at $399,000. I'm more than willing to bet that house will end up selling $100,000 off. And when people look at market value, you should realize that in order to establish a market value, it takes a willing buyer and a willing seller, cash transaction, and neither acting under duress. It's not relevant if you're the buyer what that house is on the market for. That's an indicator. What is relevant is how much can you afford. And in the case of this property in Taos, when you look at it on a price per square foot on the ask, it's insanity. It's Taos, Michigan. By the way, great snow season up there, great skiing. That fact aside, the bottom line is that house is worth $100,000 less right now today. That house isn't going anywhere. I said, if you're serious about it, sit still. Wait 60 days until they get into a panic, and then you can move in. But it is worth what it's a nice house. It's a small house, but it's a nice house. But at $399,000, no, that's ridiculous. The point is, it's not necessarily the price per square foot you should be looking at. The question is, how much does it cost to maintain it? And how much does it cost to pay the taxes?
And to reiterate what he just said, the price per square foot is getting us there, right? That's just the beginning part of this. You still want to do research on the area, the condition of the house, inspections, but this is the beginning math part, right? And this is also gross. Now for Buffalo, I asked him what subdivision. Remember, you guys, it's hyper local because he said there's bidding wars, right? You guys heard Buffalo, you said it. There's bidding wars in River Oaks. But when I go to River Oaks, and this is why I do my own research, I can't listen to comments because you guys can't see behind the scenes. There's 52 homes in River Oaks listed right now. So it had to be the house. I don't see how there could be bidding wars when they have 52 listings in just one subdivision.
Or she's working with a realtor and the realtor said there's a bidding war, right? This is the exact same issue that I got into with KW when they asked me to do an interview for them. It's the exact same issue.
It drives me crazy. But Buffalo, I wanted to show you this, okay? So because this is River Oaks. So there's 52 listings. Now I'm going to categorize these listings by price per square foot. Okay, again, you still have to do research, but these are the homes right here. Oh my God, $53 a square foot. How is that possible? But these are the homes right here that should have more wedge. So if I was you, if I was looking at River Oaks, I would start from this list from the top down because look at the price per square foot. Let's look at this one. $53 a square foot. That sounds almost impossible. Let's see what this looks like. How is this $53 a square foot? It's got to be in horrible condition. Okay, I mean, it's not in the best condition. Let's see here. Oh, it looked like it was the roof was falling. No, that's just overgrown. Let me look on the inside. It's got look at geez. Okay. So yeah, it's a fixer upper, obviously. But that's how I would do it. Now, this has been on the market for 430 days. So that's not one that has a bidding war, right? Let me go back here to so if I go back to this list. And I'm going to show you also last thing, Buffalo, and I really appreciate it. Here's the other reason why I'm saying there's probably not bidding wars in there because look at the days on the market, 30 days, 51 day. And this is, remember, this is in River Oaks, 30 days, 51 days, 393 days, 36 days, 403, 18, 190, 48, 28, 19. There's not bidding wars. So you may have gotten into a bidding war with one other person on the same house because you were unlucky, right? Or the house was priced way under the market. I don't know the nature of the deals, but what I can tell you is this doesn't appear. Obviously, I'd have to go there, right? I will go there to make my final determination because it's just numbers. But just from the numbers, there's absolutely, overall, there's absolutely not a bidding war in that subdivision. Absolutely not. Because again, look at the days on market. You have price cuts here and look at the price per square foot. So I don't know, I would have to talk to your agent a little bit, Buffalo, and figure out a little bit more what happened. But I really appreciate the support. And hopefully I answered your question by going into MLS like that. We're going to move on to our third video. Okay, so consumer sentiment comes out. Let's look at consumer sentiment. Okay, that's not good. Let's see if this impacted the markets too. The markets flipped again. Okay, consumer sentiment tumbles in April, obviously, as inflation fears spike. University of Michigan's survey says the survey mid-month reading on consumer sentiment fell. Oh, it fell a lot to 50.8, down from 57, and 57 was bad. And the consensus was 54.6. So this is much lower. Let's see if the markets are reacting. This is crazy. They were just up. Mitch, do you see the line? They were just up. I was gonna come back in and say, oh my God, the market has reversed. It's up again. And look at this. On the news of the sentiment, it's got to be the sentiment. On the news of the sentiment, it's been out for 12 minutes. The market has reversed again. And the VIX has gone down. Oh, what is the VIX doing? What's the VIX doing right now? Let me see the 10-year real quick. Golly, look at the 10-year, Mitch. Oh my gosh, man. Oh my gosh. Okay, so the 10-year is at 4.53. This is going to be a huge increase in mortgage rates today, but it's up 10 basis points. Look at that trajectory. I mean, I can't get over it. I'll stop talking about it, but I mean, geez Louise. All right, let's go into our next video, which is going to be the fact that tariffs probably will increase unemployment. So this is a segment on tariffs increasing unemployment. Dang, we're an hour and 13 minutes live. I appreciate you guys hanging on this long. All right. Tell me if the audio is okay, and I appreciate you guys.
Let's get over to Steve Leisman. He's got some breaking news from the Fed. Steve.
Yeah, and also some good tag team stuff with what Sarah was just talking about. Schmidt saying that Kansas City Fed president Schmidt saying that in the conflict between growth and inflation, he intends to keep his eyes squarely focused on the outlook for inflation. He says he's hesitant to embrace the theory that tariffs are one-time price increases. This is the kind of tough talk we've heard from other Fed officials. He's concerned that a further jump in prices could push up inflation expectations. And once inflation is embedded, it becomes more difficult to contain. He's not willing to take any chances with the Fed's inflation fighting credibility. So again, more tough words, very much echoing what Powell said on Friday. Lori Logan also chiming in. She does say the Fed is well positioned right now in terms of its current policy. So not expecting any big change here, but higher tariffs would boost unemployment and inflation, and the Fed should keep tariff-related price increases from becoming more persistent. In other words, it's the Fed's job here. On this issue of what changed yesterday, a reduction in downside risk, but it didn't go away by any stretch of the imagination. Take a look at some of the calls that we're monitoring here. Goldman did walk away from an odds-on bet about recession, but went down from 65 to 45. MetLife went from 75 to still above 50% at 60%. I emailed Bruce Kasman from JP Morgan. He's maintaining his recession risk, says risks have moderated. And Morgan Stanley says the pause lowers the immediate downside risk, but prolongs uncertainty. I don't know if the concern about this, and then real quickly, here's another look at what Sarah was talking about. I got a range of views out on the street. Oh, here's Citi saying pausing reciprocal tariffs excluding China does not essentially mean the U.S. economy has avoided a slowdown in growth. And just here's the trajectory. We had a 3% tariff rate before. The Rose Garden tariffs raised it to like 30%. And now, very much like Sarah was saying, I'm seeing the effective tariff rate, including China, 20 to 25. Wells Fargo's at 27. So the bottom line is, guys, we still have very high tariffs in the United States, and economists still need to forecast lower growth and higher inflation from both of them. Guys?
Okay, thank you. That was very helpful. Let me take you off mute, Mitch. Oh, wait, you're not on. You got to unmute yourself. I can't. You have control of it for some reason. All right. So did you unmute yourself? Okay, it's unmuted. Okay. All right. I'm going to just go straight into the derivatives. And look at the comment that I have up here. It's a perfect comment to talk about derivatives because we're going to, this next segment, let me put a timestamp on it. Because this is going to be very, very important. And we're going to try to respond to some very difficult questions and concerns about withdrawing early from 401ks, like taxes and penalties. So this is a good comment, Mitch, to have up as I'm going through this quickly. And then I'm going to give you the mic, Mitch, for the rest of this. But Travis, inside my 401k, there's an option to move the balances to cash or a trust. I have Fidelity, and this is what I did. Get the people to review their options in their plans, no penalty. So that's why we said too, I mean, every 401k is different and there are different types of IRAs. I mean, you got to call. You got to call and you got to see what you could do. But let's go into the derivatives, which do impact your 401k. Now, Mitch already has this out. He has a thesis on this. I'm going to have it linked in the description. His is way more thorough than what I'm about to show you guys. I'm just going to nip some things in the butt for you guys. So make sure we're all on the same page. But how big is the derivatives market? And remember, the derivatives is like your leverage up market. So this is where they're leveraging up paper. There's no assets here. There's an underlying asset, but no one ever owns this asset. And this is what this says. The derivatives, I'm just going to do the key takeaways real quick. So I want you guys to understand how bad this is and how big it is. The derivatives market is said to be over $1 quadrillion. Okay, in notional value on the high end, but some analysts say that the market is grossly overestimated. The higher end of the estimates include a notional value of derivative contracts. But look at this, guys. Let me show you this. There is a large difference between this is what you have to understand. This is the leverage, notional value, and actual netted value of the derivatives. Look at this. I'm going to move this up. This is what you need to understand. Okay, all that Mitch has been training, and most people are getting this. Some people, because this is confusing, I get it, and we just want to live our lives and be happy and nurture our relationships and children and these things. But you have to understand this. Okay, look at these numbers side by side. So there's a not notional value because it's paper chasing paper leveraged up of 600 trillion. But the net actual value is 12.4. That means that, what is that? A 30 up, 1 to 30 leverage? My point is I mean, it's so grossly leveraged. Why are they allowed to do this? There's not even any assets. Let me read a couple things here. Definition and core mechanism. We're talking about the derivatives market. I want each and every viewer to be able to discuss this at your, I'm going to say your next party, but I don't want you guys going parties, at your next bingo game. Okay, that was stupid. I shouldn't have said that. But listen, the derivatives market, we're going to talk about this. The derivatives are a financial contract tied to the value of an underlying asset, such as a stock, commodity, interest rate. They're running bets on interest rates? How is an interest rate an asset? Or currencies? The market allows participants to hedge against risk, speculate or manipulate future price movement, or gain leverage exposure without, here's the thing, without owning the actual asset. Without owning the actual asset. Transactions are either standardized or traded on exchanges, or customized and traded over the counter. And the over the counter trading makes it very, very difficult to regulate and understand what's going on. So when I listen to the Treasury Secretary say they need to deregulate small banks, and then I look at 1 quadrillion versus 12 trillion in actual value, it really makes me think he's just a tyrant. It makes me think he's a charlatan and he's lying to people. Why would you deregulate? You need to regulate more. You need to, and when I say, if they're going to deregulate, let them fail. If they're going to deregulate, you got to let the banks fail. Now, here's the thing. This is adding one thing. Key participants, market participants typically fall into 4 categories: the hedgers, the speculators, margin traders, and here seems to be the biggest problem of all that's going on right now, the arbitrators. They exploit price differences for the same asset across different markets for profit.
Arbitrager.
Arbitrageur. Sorry about that. Now, I want to show you guys this too. This is a printout, and this is to April 7th. It goes to April 4th, though. Okay, so this is going to April 4th. This is the performance on a 60-40 retirement portfolio. And again, this is not taking into account the last few days of volatility, but this is to show you guys that they're dropping. 401ks are dropping. You see that right here. But I'm also putting this up because I want you guys to see the growth. So like people like freaking out, like, oh my God, my 401k is dropping. But don't forget, if you look since 2016, you should be what? Double up? You should have double the profit. So if you're really worried, understand all you're doing is you're cutting out, the fraud anyways. The fraud in your 401k is absolutely outrageous, but that's the 401k. Mitch, let's go ahead and talk about some difficult stuffs now, because we've done a couple of videos because of the volatility, and these were live videos where I've asked you the question, is the market rebounding an opportunity for mom and pop to withdraw from the 401ks? And we had so many comments, man, because there's so many different 401ks. A lot of people were like, you can't do that because the taxes. You see the comment on the screen. What we said is you have to call them. But why don't you go ahead now, and Mitch is going to present some questions and answers to those questions. So Mitch has been writing down some questions from videos. He'll go over that with you. Now, after that, I'll take the Q&As, and I really apologize for not doing more interaction with you guys. I know that's what, to me, that's what life is about. It's about being together and growing with each other like a relationship. But the volatility is so bad, and the 401k situation is so important to talk about. Mitch, I have a super chat. Let me throw this up before. Are you ready? Yeah, you got your form up. I see that. Someone did another super chat. Here it is. Okay. Thank you, Thomas, so much. Hi, Travis. Keep up the important work on creating awareness. Thank you so much, Thomas. I couldn't do it without you guys as a viewer. Obviously, also Mitch. I mean, this is one big effort. That's why I don't use my name. This is why this channel is called Real Estate Mindset, not Travis Spencer, because I don't want this to be about me. I want this to be about community. I want to be the guy that says, I am not important. I'm a normal person just like you. That's why I wear t-shirts, guys. I want to look like a stud like Mitch, and people ask me to become president too, but I'm a normal guy. What can I say? Thomas, I appreciate you from the bottom of my heart. You didn't have to do that. Thank you for the support, brother. Mitch, you ready for me to bring up your screen?
Yeah, I have just one comment, or it's actually a question.
Okay.
And the question is for every official, including the officials.
Oh my God, I got to... Mitch, just real quick, I'm so sorry. What's going on in the market, Mitch? I don't mean to yell in the microphone. Look at the market. It's down again. The whiplash, man. The whiplash.
Yeah.
Oh my God. I'm sorry. I'll shut up. Back to you, Mitch.
Well, remember, my target was 0.618 pullback from the high to the low. We hit 50% yesterday, so we're likely to hit it.
Look at this. Look, one more thing. Oh my God. Look at this. Oh my gosh, Mitch.
Yep.
Oh my gosh, Mitch. We're almost at 4.6. This shows you the Federal Reserve is useless, you guys. Holy crap. So the 10 years up 14 basis points. Interest rate. This is going to massively impact residential mortgage rates. I mean, that is freaking skyrocketing by any definition of skyrocketing. I'm sorry, Mitch. I will shut up. That was just some breaking news. I'm going to pull up your form. Oh, let me remove my in from the stage. Your form is now up. So whenever you're ready, brother.
So just before we get into that, I have one question for any official at the Fed, including the Dallas Fed. Just one simple question that everybody that's a viewer can actually go and ask your same official, because you have the St. Louis Fed, the Dallas Fed, et cetera, et cetera. The one question is, what are you doing about the off-balance sheet derivatives? That's the question. You're likely not to get an answer, which should be absolutely frightening. Now, with that said, we can talk about the response. So obviously there's thousands of comments below these videos, and we can't get to all of them. But generally speaking, most of those comments all follow a very similar path, a very similar pattern. And when we did the video the other day, having to do with a little bit of the derivatives and these kind of things in the 401ks and the pension, the comments were splattered all over the place. So I was a little bit concerned because some of these videos are fast and some of these videos are long. They take time to get done. But regardless of the speed of that video, there's always things that can be said that there's just simply not enough time to get the job done. So with that said, I never know where Travis is going with the questions. And that's a good thing, because that means that the answers off the top of my head, I hope, are useful for all the viewers. And if somebody is a new viewer, it turns out that they may be a little bit taken aback because they don't know where I'm coming from. But when I answer any of these questions, it's always, without exception, through the lens of the debt. The debt is the poison. The debt is the problem at the Federal Reserve. The debt is the problem at the central appraisal districts. Because of the debt at the school districts, it shows up at the central appraisal districts in the form of overtaxation and overvaluation. So my lens is purely focused on the debt because that's where the fraud is. And then we talked about the criminal complaint, and Travis will post that. But there's the criminal complaint, there's the First Amendment to the criminal complaint, and then there's the thesis and facts. All these documents tie and are absolutely linked at the hip and crammed full of evidence. And that criminal complaint is now at the hands of the DOJ. Travis is going to take what I'm reviewing right now, and he's going to put it below the video so you can read it on your own. But there's some links in there to some of the videos that we've done that'll also back up why are the school districts doing what they're doing. And I'm going to deviate for 1 second. Do you know that there's a school district in Texas that's now talking about deferring its bonds? Think about that for a second. You have bonds, you have a payment schedule on those bonds, and now you want to defer those bonds, which means those bonds go off balance sheet. You can't pay for the bonds today. Deferring them doesn't mean you're getting rid of the bonds. That means you're delaying the payments. That is the definition of bankruptcy. So all of these things, including the video, one of the videos that's linked in here, it's called They Lied About the Property Tax. That literally walks through what these school districts have done and created their own investment pools, which to them is like having a second Social Security fund. That's there. We have no idea who paid into it, what the tenure is, or anything else. The point of the matter is you didn't disclose it to the public. What are you doing? You didn't even disclose it to the teachers. They haven't got a clue where their money is. These things are all linked. That's one of the, that's number 3 inside of this document. So you can click on that link and it'll take you up to that video. One of the other points that is important. So in Godly, Texas, just very quickly, the average house is worth $160,000. The trajectory of the school district fraudulent bond debt right now today is $90,000. The problem is in 3.5 years, based on an outstanding bond that they're in the process of raising, in 3.5 years, the outstanding school district fraudulent bond debt will be greater than the value of a house. And that is happening in multiple districts. The other point is everything that Travis has got on the Teachable at this moment is free. So everything we're talking about, the videos, everything else, it's there for free to the public. Then the question was about the 401ks. Should we pull the money? Should we not pull the money? There's so many different flavors of the 401ks and the pensions. The point being that it's more important to understand where your money is. If you have a fund manager and that fund manager is getting 2% of assets under management, and that fund, i.e., as in a BlackRock fund, is managing over $1 trillion, well, I can assure you they do not care about the 20% in profit. They're there for the fees. If your fund is making your fund manager rich by virtue of the fees, and your fund, your rate of return on your money is not doing that well, that is a red flag. The question is, do you know where your money is, who is running your money, and what the circumstances are around that money? And if you're losing sleep, there are things that can be done. But as we've seen with the precious metals just in the last few days, the rate of return on the precious metals has exceeded the rate of return to such big entities like CalPERS in California. That's the state pension fund, where the average return is 6%. Well, you're having rates of return on precious metals in 2 days that exceed that versus 1 year, as in CalPERS at 6%. So the point was, everybody has to get up to speed as to where their money is. And if you're losing sleep, I would strongly suggest you get up to speed real quick. And that was the whole reason why we gave another level of thought process with regard to the thesis and the facts. Then with regard to Milton Friedman, that was a little video clip that Travis put at the very front of that. Some people didn't quite get where that was going. And in Milton Friedman's time, when Ronald Reagan was president, they also had a trade imbalance. And he was giving the analogy of, well, you don't shoot yourself in the foot just because somebody else took a shot at you. Well, that's great, except that was in Milton Friedman's time. Where we are now today is up trillions over and above anything that they could have possibly ever imagined, even at looking at the rule of 72 at that time. And that is 100%, without exception, attributable to our Federal Reserve printing trillions of dollars to backstop the banks. That is the problem we now face. So the trade imbalance is extremely real. It has got to be brought under control. But over and above that, it's a small component part as compared to the U.S. national debt. Now, if you can fix the interest on the U.S. national debt and start to get that clock going backwards, then we've got something to talk about. But the only way to do that is to start smacking down on the derivatives. You've got to get rid of all this off-balance sheet garbage that is floating between these banks that nobody can see, because every time the bank gets into trouble, the Federal Reserve prints money. It's a circular argument into hell. It's got to stop. So you've got Doge doing what Doge is doing, which is necessary. You've got President Trump saying, well, we've got to do something with these tariffs because this is bad, which is necessary. It's my humble opinion, not going far enough, but we won't dance down that road. So you've got those two elements. Somebody has to pull the big trigger on the big ticket items where there's trillions of dollars of fraud sitting there. And by the way, it's not your money. See, it never existed. These derivatives are bets. They're unilateral bets. It's no different than walking into a casino and say, well, I've got a $50 chip. Well, it's only a $50 chip if this casino will honor it. So you went and you got a chip thinking, well, I'm going to be able to do something with that in the future. That's basically what these derivatives are. It's paper chasing paper. It's not backed by an asset, and the paper itself isn't an asset. So you've got to understand that this stuff is easy to unwind. Yes, is it going to clip the banks? You betcha. Is it going to hurt the shareholders of the banks? Absolutely. But the point is, the government can put floors underneath all that. They can say effectively immediately, we're going to start to work all this down. And to this point, nobody has done it. Nobody wants to talk about the derivatives. But it has to be done because mom and pop cannot be expected to backstop this garbage. They didn't create it. Mom and pop should not be in the position where their equity has been stripped out of their house to carry off and fix the damage that was created by the Federal Reserve in the first place. So these, right, you got the central appraisal districts at the local side and you got the Federal Reserve at the federal side, but they're mirror images of fraud because none of it is true, but they end up in both instances stripping the equity from mom and pop. Then you've got the third layer, the devil in the room, which is the derivatives. So that was the point of what we were trying to get through on that video. The other issue that was outstanding, the mainstream media does not talk about anything that we're going through, and we're talking just amongst us friends here. And that's a problem because when you listen to the mainstream media, you can be deluded into thinking that everything is fine. Yet when you look at your own household and you realize how much in taxes are going up on your real estate on an annual basis, they're not fine. When mainstream media says, well, consumer sentiment is this, who gives a damn? Consumer sentiment is somebody sitting in a room saying, well, I think based on the surveys that we've got, this is the net result. You've got so many flaws and so many backstops that are going on inside of that. It's a ridiculous thing, the consumer sentiment. The only thing that matters out of all of this is the median household income. If mom and pop can't support anything past that median household income, there isn't anything to talk about because the next level up is pure bankruptcy. That was the point. And the problem with that video was it was short, it was hard hitting, and a lot of people kind of were not following where the logic was going. So this comment, this little diatribe that I went under will be below the video that Travis is about to release.
All right. Very good, Mitch. So I took that off your screen. It's just you and I have some questions. I'm going to try to get to some of these questions as quickly as possible. It's some really good stuff here. I'm going to start from the bottom up. Actually, let me start here. Okay. So the Dixie, I had a comment on the Dixie. I meant to bring that up, and for some reason I didn't bring that up, but here's the Dixie. That's not the Dixie. That was just a blank screen. That's the Dixie. So yeah, it's under 100. It's 9966 right now. Let me just keep going. Now, Trevor's asking, so Mitch, are you simultaneously preparing a federal class action lawsuit for property owners? I don't believe that it's a class action, correct?
No, we can't do class action. Well, in theory, you can. The problem is the courts in Texas frown upon it. However, one of the attorneys reached out to me a few weeks ago out of Arkansas, and he got permission from the court to roll forward on his class action, which is hallelujah. Great, perfect. So there are things that can be done. If we go to the U.S. Supreme Court, it's only a direct result at the moment because the Fort Worth Court of Appeals would have punted just like the original judge did. They don't want to hear it. It's not that they can make an argument against the facts because they can't. They just simply don't want to touch it. But
Missouri?
We'll see. Say again?
That was in Missouri, right?
That was in Arkansas.
Oh, Arkansas. I'm so sorry, Mitch. Okay, got it. Arkansas. Okay, very good. And now here's a good one right here. This is from Pirate Justin. Real estate mindset. What makes you think, and this is a fair question, what makes you think that the Department of Justice are going to take these criminal complaints seriously? Mitch, you want to respond to that?
Well, I would simply ask one question. What in the document isn't true? See, the point is, it doesn't mean that they have to pull the trigger. The point is they can't answer the question. Well, if you can't answer the question that if everything is true in the document, then the laws have been broken. It's irrefutable. And that's the point we've been making on this. Even when the court case, the original one, what in the document that we have put out with regard to the property valuations isn't true? Well, if it's true, then the CAD violated USPAP. CAD violated USPAP. That's a violation of the Texas Constitution under uniform and equal. It's a violation of the Texas Property Tax Code. It's a violation of the U.S. Constitution. Why? Because of the 16th Amendment to the U.S. Constitution prohibits a tax on unrealized gains. Again, what in the document is not accurate? That's the point that we even reiterated to the DOJ under the First Amendment to the criminal complaint. So
Very
far,
good.
crickets.
Very good. Very good. I'm going to try to get through these. I'm going to like shoot through these real quick and then kind of get to one. So this is from Tim. Okay. You know, he's not wrong, but it is sad. People are refinancing because they can't pay their mortgage. It's all a game that they will lose. And they do that because a lot of people will cash out on their escrow and then just reestablish an escrow through their equity because it makes them feel like they're getting cash out, but they're not. They're just taking their equity. And I mean, people do this. I've seen people want to refinance for $10,000 just to get, so the closing costs are $10,000 and they're getting $10,000 back and they're redoing their amortization schedule. That's absolutely bamboozled. I mean, if you're not refinancing for the right reasons, you will get bamboozled from the lenders because that's how it's set up. That's how mortgage is set up. It's amortized to keep them rich and to keep you paying. Let me keep going here. Travis.
There's one thing about that comment though.
Real quick, let me just, Dean, I finally got it, Mitch. I'm up to the city council, Travis Spencer for city council. Okay. I'm going to make my way to the presidency. All right. Dean, I hope you vote for me. What were you going to say, Mitch? I'm so sorry.
That previous comment is an indictment on the school system, because think of how different things would be if the school system taught what it is that we're discussing here through all these videos. So you're right, the person can't afford it. But if the school system was doing its job and explained, well, this is how you balance a checkbook, this is how you do things in life, and you don't want to get in debt. There's just a handful of very simple things. But had that person have known that maybe 15 or 20 years ago, that person wouldn't be in the predicament they're in today.
I got a couple of 401k questions I'm going to save for the end here. This is from Charles. Oh, and they increased the debt ceiling to, by 5 trillion. So, I mean, that's why I'm worried, right? You're increasing the debt ceiling. You're not talking about paying it off. Real quick, let me just keep going here. The moon landing was faked. What? Have you guys seen my intro? I have an astronaut on the moon jumping, saluting you like this. I wonder if that has any meaning to it. I don't know. All right, let's keep going here. Okay. Fed chair will soon come out with a bombshell for lower rates sooner than you think. Note this. I wanted to bring that up because that's what Mitch and I have been talking about this entire week. Like especially the derivatives market, the arbitrageurs, and I mean, it's not looking good. What was it? What was it they were trying to work on and talking about a $2 trillion bailout for hedge funds? It was the what was it? The trade. Can't remember what it's called, but it was for hedge funds. Not good. That really concerns me. Yes, Congress can get rid of the Federal Reserve, so that would be interesting. So let's see here. This is interesting. So everyone in power seems to be complacent with the mass scale of fraud, and either they're complacent or they're just useful idiots. Like they don't know because they're not shown it, right? Like remember those bond review guys that you're talking to? He was a useful idiot. Like he didn't know the fraud because he couldn't even get access at the bond review board to the information we were requesting. Do you remember that?
Yep. So,
I mean, he's more of a useful idiot than actually understanding that there's fraud potentially going on. Let's keep going. And I'm going to throw this first 401k up. This is an interesting comment. If you're within 5 years of retirement, your 401k should have already been moved to a highly conservative asset. If you're not within 5 years of retirement, keep contributing to your 401k because eventually it will go up. Do you agree with this comment, Mitch?
Here's the problem, and this is what everybody has got to understand. If you say, okay, I moved my 401k into a more conservative structure, but under that structure, and you don't know that it's under that structure, they are taking derivative bets through credit default swaps or credit loan obligations, things that A, you don't understand, B, you can't see, and C, you can't quantify, then in fact, what you think is highly conservative is highly risky. And that's the point of this. If you can't see it and it's off balance sheet and it's part of, Lord knows, $600 trillion worth of derivatives, you've got a problem. And if that's in your bank, because your bank is doing cross-collateralizing with other banks, this thing is sick and twisted. And that's really why I call it the devil. It's something you can't see, but it's there. They know the total dollar amounts, give or take, but where all that cross-collateralization and all the moving of these derivatives is occurring, if you look at the thesis, on the thesis and fact document is a list of the participating banks with the Federal Reserve. So the Federal Reserve takes what has a alleged market face value of an asset, which clearly cannot be true. It's a fraud on its face, but that's what they're doing. Now, why is it a fraud on its face? Because when you get a downdraft in the market like we've had, well, if you went out 10 days ago, the face value 10 days ago is not the face value today, yet the Fed substituted out the bank's assets, paper chasing paper. It's not real, but they call it an asset, for a US Treasury to go and stick it on the balance sheet of a bank that may be in trouble. So it gives the illusion that the bank is not in trouble. Okay? Well, if your fund is invested in any one of this sphere, you do not have a conservative asset base. And then further point, you don't own the money that's in your bank account. The bank does. When you transfer it over, the bank owns that money. They give you back an IOU. So if that bank is in trouble, they could do what literally happened in Lindsay, Oklahoma, which is called a bail-in. You saw that happen in Greece. So the point that I'm hammering on is things are not what you think they are. They may be, but there's a high probability they aren't. And that's why having money outside of the system, even if it's cash, sitting in a backyard buried somewhere, even if it's precious metals, you've got something that is in your control. And that's really what this comes down to. You can say, well, I'm a 401k, I believe in the future for the long haul. That's great. That's your business. But don't go in blind because some idiot in the press is saying, well, you should have this and you should have that. You've got to get in under the hood and realize, where is your money? Where is the risk? And there's so many of these 401ks and so many different types of pensions. It's like the flavor of the week. It's like Baskin Robbins. It doesn't matter. You got to get through the flavor of the week and say, okay, this is what I have to deal with. My money is invested in this fund with this manager, and this is what they put that money in. And then if you're comfortable, that's your business. But at least you know.
Well said. I mean, you guys hear Mitch. I mean, Mitch, he's so smart, yet I cannot get you to acknowledge that the moon landing was fake. At least there's many questions we should be asking about the moon landing. So smart, and then you want to talk ancient civilization? We won't do it. We won't do it. But I love to talk about that stuff. It's like the one thing that I think I know maybe a little bit more than Mitch, like the one thing, right? All right, now let's keep going here. I have super chat. Excuse me. Sorry, guys, I didn't mean to cough into a live video. So this is from Pigo's trading desk, and they're saying, thank you for the support. 34,000, period. Tariffs equal 34 in gematria. What is that? Gematria? They move. Yeah. Any comments there about tariffs and about anything there?
Well, no, because the tariffs, as we sit here today, they still mean nothing, right? I mean, think about this for a minute. What has happened in the last 10 days in this whirlwind? Nothing. Okay. And they mean nothing. You know, the proof is in the pudding, right? Now, President Trump will say, okay, fine, we got billions coming in because people are starting to negotiate. Okay, that's good. That's perfectly fine. But as far as the market is concerned, that's my point to you, is that everything we've been discussing in the market for the last several days, this is going off technicals. This had nothing to do with the tariffs. If you want to be concerned about something, be concerned about the derivatives. The tariffs will straighten themselves out in due course, one way or the other. But it's the derivatives It's the fraud in the system that you should be concerned with. The market traded based on the technicals, had nothing to do with the tariffs. It was just coincidental that the tariffs were there. The tariffs may have been the tipping point, but that's not why the market did what it did.
Okay, very good, sir. Very good. So I got another one for you, unless you want to talk about the moon landing. Everyone will log off once I start doing that. All right, so this is from Scott, another 401k, and I want to talk to you about the taxes too. But 401k, if your plan allows you to roll your money into a qualified IRA, and I just want to go back into his start of his statement. If your plan allows, right? That's the key word. Call your plan provider and see what you can and cannot do as far as fees and early withdrawals and transferring your assets. Minimize the tax and penalty impact, lower fees, and greater investment option from an IRA. Anything you want to say there? Or do you want to keep going, Mitch?
Yes. Okay. Let's talk about the taxes for a second.
Well, explain to the viewers what you mean. What taxes?
Well, taxes are paid based on profit. Okay.
For your IRA, for your early withdrawal. Mitch is talking to you guys about the taxes that you would pay for withdrawing your 401k.
Yes. So if there was a penalty, you pay the penalty to eliminate the 401k and pull the just to eliminate it. And then somebody said, well, okay, but I have to pay taxes. Yes, because if you made a profit, you would pay your taxes. But where that person was headed when they didn't quite follow their thought process through, what's the alternative? If you say, well, I'm going to pay taxes because I made a profit, but I don't want to pay the taxes, so I shouldn't make a profit. The point is you have to protect your profit. And if you're losing sleep at night and you can't protect your profit, you're much better off pay the taxes. Now, put that to the left side of the column for a second. There are IRAs that will allow you to hold precious metals. So again, everybody's got a flavor. It's like Baskin Robbins. Here's the problem with that. Holding the metals should be within your control, not somebody else's control. If you have a bank that's weak and you have assets in that bank, you really don't want to have assets, i.e. cash and or precious metals, having anything to do with that bank. Over and above that, you have ETFs in today's world that are allegedly holding the precious metals, and it turns out that that's not the case because some of the metals has dual ownership. So this is about controlling your future, and you can't be, listen, you can do whatever you want, but if you listen to the press, or everybody's going to play nice and you should do this and you should do that, and that's the norm of society, the norm of society is wrong. When you understand how those derivatives are there and the norm of society doesn't discuss the derivatives, the norm of society doesn't discuss that the money you put in the bank isn't your money anymore. You gave it away. When you put it in the bank, you gave them your money. They gave you back an IOU. If they can't pay it, they're going to end up handing you shares in a defunct bank. The norm of society doesn't discuss that. And the reality is that's why you're here. That's why you're looking at being a viewer. You know something is wrong implicitly in your gut. You know something is wrong. We're pointing it out. And when you look at the criminal complaint, and I beg everybody, go read the First Amendment to that criminal complaint and go read the thesis and the facts. When you get through those two documents, what in those documents isn't true? Well, if it is true, which it is, then you clearly see what the problem is, and then you can articulate it. You cannot be hiding behind the norms of society and say, well, this is just what everybody's doing. That's called being a sheep being led to the slaughter. And that's where we are.
Well, I don't want to be a sheep being led to the slaughter. That's why I bought some silver. Hopefully that silver will keep me on my right path. All right, Mitch, we're at the hour and 52 mark. I have an appointment in 7 minutes I completely forgot about. And so I'm going to get going here. I just wanted to tell you guys, we appreciate you joining us. Don't forget, everything is going to be chaptered here. And I'm going to give me about half an hour, but I'm going to go back to this video. I'm going to add all of the links. I'm going to add the criminal complaint, the thesis, the response for the video. And then also I'm going to add this, you guys. Don't forget about this. This is important. Okay. We made this for you. No one else has this. Okay. This is completely free. Our seminars we're paying for, but this entire platform is free for you. No one else has this. This is a one of a kind how to keep your house. So if you already own a home and if you are renting and want to own a home, so come to the Empowerment Center, multiple courses, video courses for free. There's 2 right there. Those are free courses I made for you guys. No one else. For you guys, I made these courses. So you can also take a look at our digital downloads here. Criminal complaint draft is right here. Letter to repeal property taxes here. Here's how to end property taxes. If you guys already own a home and you want to learn how to fight your property taxes, I have a seminar tomorrow. I have a couple seats available. It's called How to Protest Property Tax Home Value. Again, that is tomorrow. If you want to come to it, come tomorrow. It's going to be in the link of this video. Other than that, guys, we really appreciate you. Happy Friday. Make me proud this weekend. Go save some money. Go nurture the relationships that you love in life and go have a picnic and talk about rebudgeting. Talk about how you plan on getting ahead. Don't just not say anything, especially if you have a spouse. Don't just not say anything. Trust me, everyone is suffering, even if you're not saying it. So communicate with each other. I really appreciate you guys from the bottom of my heart. We got so many super chats today. I really appreciate that. That means a lot to me, you guys. Les, I see you. Les, I see everyone. Dean, thank you for participating. All you guys, thank you so much. Don't forget, hit the like button. And other than that, if you guys are out there investing in real estate, investing in yourself, you guys already know, or even in your 401k, we wish you luck and we hope you